Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. Oil tops $100. G7 convenes emergency SPR release discussion. 2. U.S. payrolls drop 92,000. Stagflation risk reprices Fed path. 3. BlackRock gates $26 billion. Credit fund. Private credit liquidity under stress. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily market briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. One. Oil tops $100. G7 convenes emergency SPR release discussion. Primary asset classes impacted: energy, Brent, WTI, refined products, LNG, European gas. Global equities, all major indices, US T-curve and break-evens, safe havens, gold, JPY, CHF, DXY, EMFX and credit, shipping, airlines, industrials. What happened? Brent surged to $119.50 intraday, the largest single-day jump on record, before settling near $106.73, up 15%, after Iraq slashed production 70%, and Kuwait declared force majeure. G7 finance ministers convened an emergency IEA coordinated call to discuss releasing 300 to 400 million barrels from strategic reserves. Iran named hardliner Mojtaba Khamenei as new supreme leader, signaling no de-escalation. Why it matters. Triple-digit oil converts a geopolitical shock into a macro regime change. Energy costs at this level mechanically lift headline inflation, compress consumer spending, and widen current account deficits for importers. Central banks face a stagflation bind, cutting risks, embedding inflation, holding risks, deepening labor weakness. A coordinated SPR release of 300 to 400 million barrels would be the largest in IEA history, signaling official alarm at the demand destruction threshold and potentially capping prices near $100. Key numbers to remember. Brent peaked at $119.50 intraday, settled near $106.73, plus 15%. WTI hit $115, settled near $98.60. Iraq cut output 70% to 1.3 million barrels per day. Kuwait and Qatar under force majeure, approximately 20 million barrels per day at risk. G7 discussing 300 to 400 million barrel SPR release, representing 25 to 35% of total IEA strategic reserves. What to watch next? The G7/IEA outcome is the immediate catalyst. A credible, large-scale SPR commitment could cap Brent near $100 and provide a floor for equities. Failure to agree or an underwhelming volume would likely push Brent toward $120+ and trigger recession pricing across cyclicals, EM credit, and rate-sensitive assets. Monitor whether Saudi Arabia activates spare capacity or begins its own cuts as storage fills. Any ceasefire framework from Tehran's new leadership would reprice energy sharply lower and support global risk. 2. U.S. payrolls drop 92,000. Stagflation risk reprices Fed path. Primary asset classes impacted: UST front end, 2-year Fed funds futures, SOFR strip, U.S. equities, S&P 500, Russell 2000 cyclicals, DXY and major FX pairs, gold, EM sovereign credit. What happened? U.S. non-farm payrolls fell 92,000 in February, far below the plus 60,000 consensus, with unemployment rising to 4.4%. January was revised down to plus 126,000. Healthcare lost 28,000 jobs, partly from the Kaiser Permanente strike. Construction and leisure also contracted. Average hourly earnings rose 0.4% monthly and 3.8% annually, both above expectations, delivering a textbook stagflationary data combination alongside the oil shock. Why it matters. Falling employment alongside rising wages and an oil shock creates a dual mandate conflict for the Fed. Labor deterioration argues for easing, but accelerating energy-driven inflation and sticky wages argue against. Market pricing for a June cut rose on employment weakness, yet the oil backdrop may prevent the Fed from acting. This ambiguity keeps volatility elevated across rates, equities, and FX until Wednesday's CPI clarifies the inflation trajectory and the FOMC meeting on March 18th to 19th sets guidance. Key numbers to remember. NFP, minus 92,000 versus plus 60,000 consensus. Unemployment at 4.4%, up from 4.3%, third decline in 5 months. Average hourly earnings, plus 0.4% month-over-month, plus 3.8% year-over-year, both above forecast, complicating the easing case. S&P 500 closed at 6,740 on Friday, minus 1.33%. Worst weekly decline, minus 2% since October 2025. What to watch next? Wednesday's February CP is now the single most important data point for the rates path. Core CPI at 0.3% or above would compress June cut probability and push 10-year yields toward 4.30 to 4.50%. A soft print at or below 0.2% would stabilize front-end expectations and allow a technical equity relief rally. The FOMC meeting on March 18th to 19th becomes pivotal for forward guidance on how the Fed weighs simultaneous labor and inflation risks. A hawkish hold would support DXY and pressure EMFX. 3. BlackRock gates $26 billion credit fund, private credit liquidity under stress. Primary asset classes impacted. Private credit and alternatives, BLK, Blackstone, Apollo, Ares. U.S. financials and asset managers, high yield and leveraged loan spreads, broader risk sentiment, and funding markets. What happened? BlackRock capped quarterly withdrawals at its $26 billion HPS corporate lending fund after redemption requests reached 9.3%, nearly double the 5% gate limit, freezing $1.2 billion in outflows. Separately, Blackstone's $82 billion flagship fund saw record redemption requests, requiring $400 million of the firm's own capital. BlackRock shares fell nearly 7%, dragging the broader asset management sector lower. Why it matters. Gating a flagship fund from the world's largest asset manager sends a structural signal about liquidity risk across the $1.8 trillion private credit market. Unlike public markets, private credit holds illiquid assets with opaque pricing, making forced selling deeply destructive to remaining investors. If redemption pressure spreads to other large vehicles, it could trigger a negative feedback loop between fund gates, mark-to-market losses, and further withdrawal demands, amplifying credit, tightening beyond the direct energy shock. Key numbers to remember. BlackRock capped HLEND withdrawals at 5% after 9.3% redemption requests. $1.2 billion in requests frozen. Blackstone's $82 billion fund saw record outflows. Firm injected $400 million of its own capital to meet redemptions. Private credit totals approximately $1.8 trillion globally. Gating events risk contagion across leveraged lending markets. What to watch next? Monitor whether other major private credit managers, Apollo, Ares, Owl Rock, report elevated redemption queues this week. Credit spreads in leveraged loans and high-yield bonds are the transmission channel to watch for contagion into public markets. If gating events multiply, banks face rising counterparty risk on credit facilities extended to these funds. A broader de-risking episode would tighten lending conditions for mid-market corporates and amplify the macro slowdown, particularly if oil prices remain elevated and equity volatility persists. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely.
Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.